Debt to equity ratio is a fundamental financial metric used to measure how a company finances its operations and growth. It's like a financial health check offering a snapshot of a company's capital structure. This ratio quantifies the proportion of debt used to fund companies' assets compared to equity that are contributed by the shareholders. In simpler terms, it answers the question how much of the company's operations is funded by borrowed money and how much is funded by owners or shareholders. A high debt equity ratio suggests that a significant portion of the company's operations is funded by debt, which can be a sign of financial risk. On the other hand, a lower ratio indicates a conservative financial structure with a larger reliance on equity. So, understanding this ratio is crucial for investors and lenders because it helps to assess the level of financial leverage and risk associated with the entity. A balanced debt to equity ratio is often seen as a healthy sign, striking the right balance between the debt and equity to support growth and stability. So, to summarize, debt to equity ratio is a vital tool for evaluating an entity's financial health and risk profile, and it provides insights into how it chooses to finance its activities.